You give your one stock, highly appreciated stock, into this pool as an exchange. So do other people. And then you end up with a share, so do other people, with a fractional interest of all these different stocks. The pros are diversification. The pros are tax diversification. Love it. But there's cons.
Hey, Joe and Big Al, this is Bryan from New York. I'm a new listener, and my first question is, why ain't Andy's photo up on your website? I don't know. Andy, why
My
isn't
photo is up on the website, but they're asking specifically about the Ask Your Question page. And I think the reason for that is because I'm not the one that answers the questions.
I think we got to change that. I think we made an executive decision earlier. It's like, ask Andy.
Yeah.
Okay.
That's right.
I think we should just make it Ask YMYW.
That's good. We'll just critique our answer. How about
Yeah.
that?
Or ask
Oh,
Andy,
boy.
gives it to us, and then we'll answer it.
That works too.
Okay. Anyway, I drive an Audi A5 and a BMW M3.
Wow. That's living large.
Drink of choice is a tequila and seltzers with limes. All right. Interested in your spitball on a 1% problem. I live in New York, and my wife and I are in the 35% federal tax bracket. Plus, we get hit with NY state on top of that. When I retire at 64 in 4 years, we plan to live in Florida at retirement, and then I plan to do mega backdoor as much of our $4 million combined pre-tax 401ks as possible until age 70. $4 million in a retirement account. Good for you, Big Bryan. My question is about the large unrealized capital gain I have on my employer, that I have from my employer. I'm sitting on $2 million position with over $1.2 million in capital gains. I'm starting to research buying into an exchange fund, sometimes retired to as a swap fund or referred, where you exchange your securities for shares in a fund, which the IRS requires to stay in the fund for 7 years, and the fund diversifies your position to a mirror index, like the NASDAQ 100. After the 7 years, you still have the same cost basis, but now you have a diversified portfolio. And assuming I don't need the money, I will get a step-up basis after my wife and I are gone. Any thoughts on the pros and cons of an exchange fund? Keep up the great work. Okay, so a couple things here. He's got $4 million in a retirement account.
Sure.
And he's going to convert a bunch of that money to a Roth IRA as much as possible until age 70, I believe. But then my question is about large unrealized capital gain I have from my employer. So is it his employer stock that he purchased for $1.2 million and it's worth $2 million today? Is that what?
Yeah, he purchased it for 800,000 because the gain is 1.2 million. So $2 million position with a $1.2 million capital gain. So he would like to diversify, but to diversify, 60% of it is going to be capital gains, which can be kind of pricey.
He doesn't want to sell it because he's going to pay the tax.
Yeah, right.
And so it's like, well, here, I don't want to pay the tax at capital gains rate plus the state of New York plus the net investment income tax. So he's going to lose 30% of the 1.2, $300,000 roughly in tax is going to go. So he's going to net $1.7, $1.6 million out of the $2 million stock position. Then he's going to reinvest that in a diversified portfolio. But the account is worth a lot less because he had to pay the state of New York and the feds. So he's like, okay, well, here, what are some other strategies that I can do to diversify? Because the market could take 30% in a year as well, right? So he's got $2 million or more. He's got an individual concentrated security position where that stock could lose 30% in a year or overnight or over several years. So it's like, I don't want to pay the tax, but I'm not comfortable with the risk. So is there some ideas or strategies that I should be thinking of? And his ideas in exchange fund.
Yeah, Joe, and before I sort of get into that, so things that people do is they come up with a sales strategy. Maybe you can accommodate so much capital gains each year over time, which I think is what most people do, because that way they have ultimate control. They don't have their money locked up for 7 years, as you say. right? And so you can sell it, depending upon what capital gain rates are. And capital gain rates, they're the lowest of rates. That, there's a 15%, there's a 20% rate. You do have the net investment income tax. You got to look at state taxes. So I think what a lot of people do is they figure out how much capital gain can I accommodate each year. Now, you may have some other positions. Can you do some tax loss harvesting, right? And maybe net some of that against that. That would be something else to look at. Some people invest in option strategies, right? So then they kind of lock in the current price, right? They sort of give up some of the upside, but they kind of lock in the current price. So there's people do that. But you're talking about an exchange fund. We don't talk about this very much, so I actually want to make sure I get this right. So here's what it is: exchange fund, also known as a swap fund. So it's an arrangement between concentrated stockholders of different companies that pool shares and allows an investor to exchange their large holding of a single stock for units in the entire pool's portfolio. So in other words, you give your one stock, highly appreciated stock, into this pool as an exchange. So do other people. And then you end up with a share, so do other people, with a fractional interest of all these different stocks, right? So that way you get diversification. So it does work. It's not terribly common, but it does work. The pros are diversification. The pros are tax diversification. Love it. But there's cons. So the cons are, first of all, probably the main one is it's locked up for 7 years, like you said. And so you got to make sure you don't need that money over 7 years, right? You still have a lot of risk, right? Because it's still a bunch of highly appreciated stocks, right? That it's not like going to be an S&P 500. You probably have a fractional interest in whatever, 20 stocks or whatever it may be. So just be aware of that. You have to be accredited an investor, and most of these require you to have at least $5 million of net worth, which maybe you do based upon what you told us. Liquidity, yeah. There are fees that go along with this. And in order to get this tax treatment, the IRS mandates that 20% of the fund assets be in illiquid assets like real estate. So maybe that's good, maybe it's not, but just be aware there's, I don't see a lot of people using it just because of all the cons, but it does work. So that's what I got to say.
Yeah. Investopedia right there. At its best. A couple of other ideas. On a highly appreciated asset like that, you could also use a tax-exempt trust. You can put it into the trust sells it. It's a tax-exempt entity. There is no tax, so you have the full 2 million. Then you can diversify, but you exchange that for an income stream. And so you could turn that on at any point. So let's say if you're retiring in 2, 3, 4, 5 years, as you're creating that income, I think this could be the best strategy because you have $4 million in a retirement account and you're going to convert that. So this tax-exempt trust will also create a giant tax deduction. So depending on how you set it up, that tax deduction could offset some of the taxes that you're doing from a Roth conversion perspective. The caveat is that 10% of the asset, depending on when you die, will go to a qualifying charity. So how you look at it, and there's a lot of pros and cons to this too. So how you want to look at this is there any of the assets that you currently have, do you want to go to a charity? And if the answer is yes, then I would highly look into this. If the answer is no, then it probably doesn't make a lot of sense. But the IRS forgives a tax if you plan a gift. And so this is this is a planned giving strategy. So you're putting this into this tax-exempt trust or a charitable remainder trust. And basically that trust sells the asset at no tax. You're going to get an income stream, but you flip that income on a qualifying event, depending on when you want that income to come to you. And so you could potentially drain 100% of that trust out or a lot of that trust out back to you. And it's going to be taxed back to you with capital gains. It could be tax-free. It's going to have the same characteristics as the asset within the trust. But again, you want to talk to a qualifying professional that understands this stuff. But there's all sorts of different things that you can potentially do to avoid or mitigate some of those taxes that is different than a swap fund. But I really like the swap fund too. You can invest in that. If you have plenty of other assets where if you want the diversification, it sounds like you hate taxes. So you'd rather to give up the liquidity and kind of go into a unique type of arrangement versus paying the tax. And I get it. I hate paying taxes too. But there's other strategies potentially that you could do along the way. But you're right. It's a 1% problem you have, Brian.
And I'll just say one more thing. If you want to get more,
please do. You don't need notes for this? Where's your
no,
notes?
no, of course not. I'm not going to talk about the exchange fund.
Oh,
that
got
I
it. Okay.
Don't know that much about. So if you want more information on what Joe just talked about, tax exempt trust, also known as a charitable remainder trust. That's the more common term. So Google that. That's it.
You want to call Big Al and he can help you out with that?
That one I don't need notes for.
Got it.